Chapter 7. Portfolio Construction. Someday, if you are lucky, your investments might fare so well that you have the extra scratch to afford a second home. Feeling flush, you buy a site in a seaside town and decide to design and build from the ground up. You hire a construction contractor to design this dream home and turn the blueprints into reality. He dives in, hires a crew, and finishes in record time. It looks beautiful on the outside, although on the inside your new house seems a little wobbly, maybe, now and then. Only later do you learn that the contractor you hired never had any training in how to design a sturdy, up-to-code house, never learned how to set up the structural ridge beam to support the roof, or how to pour the concrete foundation properly. As for the electrical, plumbing, and insulation his crew installed, forget about it. You can see where I'm going here. Most financial advisors are woefully inept at portfolio construction, and even big-name Wall Street firms don't train their brokers in how to do it. The investment portfolios erected by most Wall Street wealth advisors are wobbly houses designed by well-meaning guys whose main education is in how to sell investments rather than put together a safe and sound portfolio. At one point a few years ago, I reviewed the model portfolios of the biggest names on Wall Street: J.P. Morgan Chase, Morgan Stanley, Merrill Lynch, Goldman Sachs, UBS, Fidelity Investments, and found that all of them carried more risk than what the firm's advisors were telling their clients. This inability to quantify and evaluate risk is part of the problem with bad portfolio design. The biggest weakness in most portfolios is the lack of a special class known as non-correlated assets, investments that zig when the rest of the market zags. These contrarian instruments rise when the mainstream markets fall and head downward when the rest of the markets head upward. They are non-correlated to the movements of the broader markets, especially stocks, and the best investment advisory firms, yes, the term is relative, should constantly be hunting for non-correlated assets. An asset that closely tracks the stock market's ups and downs 100% of the time has a correlation to stocks of 1.0. An uncorrelated asset is at 0.0 because it bears no similarity at all to stocks patterns, and a non-correlated investment moves in the opposite direction of stocks. It is an all but irrefutable truth that 97.5% of portfolios are fundamentally flawed and more vulnerable to higher risk and bigger losses because they lack non-correlated assets. They comprise solely publicly traded securities, and in these highly wired times of instant global communication of information, most publicly traded securities resemble each other in their price movements. They are highly correlated to one another. Adding alternative assets is the best way to reduce risk and volatility in your account, because they can hold steady or even rise when your major holdings are tumbling downward. Many financial advisors, however, wrongly view adding alternatives as something to avoid because it may increase the risk of losses. They have it completely ass backwards. You reduce risk by padding your portfolio with assets that have different types of risk. Recall that the stock market overall has a standard deviation of 16 and the possibility of a 20% loss in any given year. By adding a non-correlated asset that has an even higher standard deviation than stocks, you can reduce risk in your overall portfolio. Simply put, portfolios cannot be safe in a world where they are reliant on all asset prices going in one direction simultaneously, whether up or down. Two common non-correlated assets are gold and treasury bonds. An even better choice is diamonds, though most people feel safer buying gold and T-bills. When the stock market panics and prices plunge, gold prices hold their own or head up as stock investors get spooked and sell to put their proceeds into gold. Treasury prices can surge as investors rush in to buy bonds that have almost a surefire guarantee from the U.S. government that they will get their money back, plus interest. Other non-correlated assets include precious gems, artwork, private loans to small businesses, even an investment in a professional racehorse. Most clients mistakenly hope everything in their portfolios will do well at the same time. But if everything is doing well, that's a problem. If all the assets are trading in the same direction, you have nothing protecting you from the downside when they all take a U-turn in unison and start falling. You want some bets that will rise in value when others go down to balance out your portfolio and reduce wild swings in volatility. A portfolio isn't entirely about return. It is about risk-adjusted return. How to get the strongest returns possible while minimizing the downside risk and narrowing the range of possible predictable outcomes. This means some investments should be doing well and others not so well, or even poorly, at all times. Constructing a portfolio that is protected is akin to playing right field in baseball. You have to be ready for anything, though most of the time a lot of nothing will happen. You may stand out there for 8 innings, slack-jawed and daydreaming, and all of a sudden a ball gets hit in your direction and the game's fate rides on your glove. You have to be in the right place at the right time to perform at your best. An elusive asset. In investing, if your portfolio lacks non-correlated assets, it cannot perform as you had hoped. The real challenge is that it is getting more and more difficult to ferret out good, non-correlated assets to fill out your portfolio and help you reduce risk. What used to work doesn't work anymore, and your broker probably has scant awareness of this. A lot of Wall Street firms still are asleep to the notion that a global convergence of correlation is at hand, and that they must broaden the search for offbeat assets. A couple of decades ago, overseas stocks and emerging markets were non-correlated to U.S. stocks, and you could hedge your U.S. investments by buying stocks on exchanges in Indonesia or Vietnam. Today, they all move in lockstep. International stocks in developed nations have a correlation to U.S. stocks of 0.94, meaning they act similarly to U.S. equities 94% of the time, and deviate only 6% of the time. Previously, they deviated from U.S. moves half the time. Non-correlated assets were everywhere decades ago. In a slower-moving world that lacked speed-of-light fiber optics, the Internet, 24/7 news networks, day trading, smartphones, and other modern mainstays. The more connected everyone gets, the more ubiquitous and fast-moving information becomes, so that everyone in investing ends up knowing the same things at the same time, and investing in the same vehicles. Finding the road less traveled has become a quixotic quest. When you first go to a new broker, typically an uninformed shill for the financial products of his or her employer, here is how usually it works. Your advisor will divide your life savings into 2 buckets. One bucket is invested at the firm. The other bucket is handed to an outside manager, who supposedly is offering some terrific targeted stock-picking strategy, when in reality it is just another form of mutual funds. By pushing some of your money off to these outside managers, your advisor is removing liability from his firm and offloading it to this other firm, playing it safe with the other half of your account by investing in exchange-traded funds, ETFs, and using some variation of the standard asset allocation between stocks and bonds. That isn't nearly a wide enough span of investment types to lower your risk. You need to spread it out among many different baskets. Building a well-constructed investment portfolio can be a lot more difficult than building a well-constructed dream house, and it can take a lot longer, too. 3 to 5 years for starters. In fact, even 5 years is too short a time to evaluate a portfolio's real success or failure. 10 years is the ideal time span needed for you to conduct a truly comprehensive evaluation. Here's a rather stunning fact on stock prices and 10-year periods. If you calculate stock's total value at the start and end of every 10-year period for the past 200 years, from 1818 to 1828, 1819 to 1829, 1820 to 1830, and so on, that amounts to 200 10-year spans. Of those 200 10-year spans, stocks lost value only once. That exception was from 1927 to 1937, in the years encompassing the Great Depression. So if you and your ancestors faithfully followed buy and hold in stocks for the past 200 years, with a 10-year outlook at the least, over the generations, you faced only one chance in 200 of losing money on stocks in a 10-year period. It is an extraordinary record. These days, however, investors who practice truly long-term investing are an endangered species. Nobody talks in those terms anymore. Brokerage firms tout cheap trades and high-volume discounts to sign up fidgety-fingered day traders of stocks. CEOs obsess over 3-month earnings reports rather than 10-year strategic plans. We hear buy and hold is dead, and shareholder loyalty has dissipated like the attention span of a smartphone addict. CNBC, Fox Business Network, and Bloomberg follow the fluctuations in the prices of stocks, energy, precious metals, and bond yields on a minute-by-minute basis every day, though none of this has much to do with long-term investing. And long-term investing is the only kind of investing you should do. Indeed, CNBC arguably is one of the worst things to happen to individual investors. To be on the air 24/7, CNBC had to make people think something mattered every moment. This just in. People started worrying more about volatility and what the markets may do, and when they started using smartphones, they had the ability to push a few buttons and trade on their fears. It is crazy how many ways a network can find to make viewers worry throughout the day, even if they aren't drinking coffee. Then Starbucks came along and made it worse. People who are nervous all day long become bad investors. There are bad investments and 100 times more bad investors. People need a wall between themselves and their money. They need to understand why volatility is killing them. Producing good television requires a heightened sense of action, while good investing is a bit like good fishing. Shut up and wait. Though I run hundreds of millions of dollars of other people's money, until recently I rejected having a TV set in my office. I want to avoid distractions and the daily frenzy and the bit stream of headlines and price movements coming across CNBC and Fox Business Network are nothing but noise. They don't count for anything. Warren Buffett might never have become the consummate long-term investor if CNBC had been on air when he started trading, though while others extol the brilliance of the supposed Oracle of Omaha, my belief is that Buffett's biggest advantage in investing is simply his longevity. He turned 87 in 2018. He has had abundant time for most of his investments to go up. Buy and hold until you die. People err by responding to emotion, succumbing to fear, and trading when they should stand idle. The more you trade, the more wrong moves you can make. In the 5-year period from 1991 to 1996, the S&P 500 index of the 500 biggest companies rose 18%, and all the investor needed to do was buy shares in an S&P mutual fund and wait. In the same period, active traders posted a decline of 11.4%. In the 10-year period leading up to the end of 2013, investors' actual returns lagged behind the returns in the assets they owned by 2.5 percentage points per year, according to a recent study published by the investment research firm Morningstar. In the 10 years leading up to March 31, 2018, the average mutual fund gained 5.79% annually, while the average investor gained only 5.53% per year. This is because individual investors tend to buy high and sell low, rather than the other way around, which itself is the aim of all investing. We see this ill-fated fidgetiness in the shortening time frame for holding on to stocks before selling out. Investors held on to a stock for an average duration of 12 years in the 1950s. This holding period shrank to 8 years in the 1960s, less than 3 years by 1980, only 14 months by 2000, and just 6 months in 2010, in the skittish aftermath of the Great Meltdown. In 2016, the average time for holding a stock was only 4 months. In 2018, it was all of 8 months. What really counts? It is all too easy nowadays for an investor to lose track of what counts and get distracted by meaningless static that seems to be more important than it really is. Before the cable news channels dawned more than 30 years ago, news took a very long time to reach the retail investor. Institutional investors had ample time to digest the news and decide what to do. The geopolitical global picture for investing evolved only slowly, decades ago. People were patient. They would wait for developments. Before they could trade out of a stock they owned, they had to reach their broker and discuss it, then put in a request and pay high fees. At this slower pace of the old days, the major stock exchanges, blue-chip stocks, and the analysts at the big Wall Street firms all reacted to news first. Lagging behind them and reacting later were the less studied backwaters of investing, including small-cap stocks, overseas international stocks, and emerging markets. Because of this delay, these backwaters moved in ways different from the major markets. The small-cap and overseas stocks were uncorrelated to the market overall. These alternative assets provided a safe haven for investors in U.S. stocks. When stock prices plunged, the backwater markets fell less, held steady, or even rose in value, because they hadn't reacted to the news yet. Then came the cable business networks, covering stock prices from the floor of the New York Stock Exchange and turning investing into a televised sport. The velocity of news skyrocketed. It went into hyperspace mode with the rise of the Internet, websites and blogs and podcasts, chat rooms, online bulletin boards, Facebook, Twitter, Instagram, and LinkedIn, all fueling fickle and furious day trading by individual investors. Now the stocks in small-cap, emerging markets, overseas exchanges, and other backwaters that had been uncorrelated to the U.S. markets react in sync with us. They are highly correlated to the markets. This is because they get their news so much faster. It takes only seconds for an isolated outbreak of E. coli at Chipotle or some other publicly traded restaurant chain to make the front-page screen of the Google News feed seen around the world all at once. Institutions and investors can react instantly, and they do, at times to their detriment. Can we all just slow the heck down? Take a look at the following chart. It shows how closely correlated each index was to others over different time periods. In comparing one index to another, a correlation of 1.00 means the two indexes trade exactly alike all the time, 100% correlation. The chart January 1991 to December 2001 and January 2002 to December 2018 will be on the bonus PDF. Less than half the time in the 1990s did the various indexes operate like one another. They shared less than 50% correlation. From 2000 to 2018, the correlation was at more than 90%. From 1990 to 2000, international markets had only a correlation of 0.24 to the S&P 500 index, which means that international mimicked big stocks only 24% of the time. That correlation was up to 0.85 from 2002 to 2018. Emerging markets before 2000 had a correlation of less than 0 compared with the S&P, at minus 0.15. That correlation is currently plus 0.90 or 90%. Coincidence of correlation. Nowadays, almost everything is 100% correlated to every other index. Even alternative-focused hedge funds are very correlated to the stock market. And if all these indexes for all these different types of assets move in the same direction at the same time, where is an investor supposed to find a safe haven that will run counter to everything else? The days are long gone when you might have had a truly diversified portfolio as far as correlation goes. The more correlated your portfolio is to the overall market, the more volatility there is in your portfolio and the more risk it carries. When the market goes up or down, your portfolio goes up or down right along with it. The key to reducing risk is reducing volatility. In order to do this, you need to be invested primarily in assets that all have different correlations, and which, preferably, aren't correlated to one another at all. This is tricky stuff, and most pros fail at it. In the past 15 years, according to a 2017 study by Standard & Poor's Corporation, 92% of large-cap funds lagged behind a simple S&P 500 index fund, and managers of mid-caps and small-cap funds fared even worse, with 95% of mid-cap managers and 93% of small-cap managers trailing behind their benchmarks. It is an embarrassment. Think about that. You are paying these people to manage your life savings. A lot of them charge 1% of your assets every year, and almost all of them fail to do any better than the benchmark ETF that you could buy on your own. Large-cap value companies, just so you know, are giant blue chips worth $10 billion or more in total market value, market capitalization, whose stock price is lower than what it should be given their underlying intrinsic value. So their stocks are cheaper pound for pound and often pay a tidy dividend. Large-cap growth companies, by contrast, are giants that emphasize growth and expansion over dividends. They reinvest their earnings in building the business, hoping to lift the stock price to ensure capital appreciation for investors and compensate for the lack of cash dividends. Wealth managers who run international stock funds will compare their performance to the MSCI EAFE index, which measures stocks' performance across 21 developed countries. It is a misleading metric, however, because it includes Japan, whose stock market has lain dormant for many years and is at the level, value-wise, that it had held in the mid-1980s. Thus, that reduces the long-term performance of the entire overseas stock index, making it easier to outperform. Why do so few managers outperform their benchmark indices? Some of it has to do with lack of training and talent. As we have seen, nobody understands how to measure risk, so how could any manager be expected to properly account for it in investments? Some of it has to do with the expectations that, if a manager runs a certain kind of fund, he is crazy not to have certain staples in his portfolio, even if they aren't good companies. A dividend-centric fund is expected to own stocks of blue chips that pay only modest dividends, even though a lot of them are extremely overvalued as I write this book. Another factor in advisors' underperformance, however, is the lack of easily available non-correlated assets to help balance out the volatility in their clients' accounts. Until 1983, nobody deemed non-correlated assets to be an important aspect of investment strategy. Then a Harvard business professor named John Virgil Lentner delivered a landmark paper entitled The Potential Role of Managed Commodity Financial Futures Accounts and/or Funds in Portfolios of Stocks and Bonds. Not exactly a sexy title, and it is as complicated as it sounds. Lentner's bottom line was that portfolios of stocks and/or bonds combined with non-correlated investments called managed futures showed substantially less risk at every possible level of expected returns than stocks and/or bonds alone. As he put it, indeed, the correlations between the returns on the futures portfolios and those on the stock and bond portfolios are so surprisingly low, sometimes even negative, that the return-risk trade-offs provided by augmented portfolios clearly dominate the trade-offs available from portfolios of stocks alone. He adds, moreover, they do so by very considerable margins. These combined portfolios of stocks, bonds, and managed futures show substantially less risk at every possible level of expected return than portfolios of stock alone, or from portfolios of stocks and bonds. Then Lentner dismounts and sticks the landing. Finally, all the above conclusions continue to hold when returns are measured in real as well as in nominal terms, and also when returns are adjusted for the risk-free rate on Treasury bills. This was groundbreaking work, and it shocked the industry. This theory has expanded to include many different types of non-correlated investments and securities. Coming up in the next chapter, we take a closer look at this gang of contrarians, starting with my list of the most non-correlated assets that every investor should consider adding to his or her portfolio.